Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to take a look at Meta. Now, Meta, or Facebook, has been absolutely destroyed in the stock market. Why? Facebook's revenue for the last quarter dropped 4%, and their operating margin fell almost in half. That's the first time that's happened in the company's history, and the market lost its mind. Zuckerberg is laying off 11,000 employees, about 12% of the total workforce. They are asking people to share desks as they consolidate their real estate positions to save money. Now let's figure out how much hard money, how much jack does Facebook actually make? If we bought the stock today and held it for 10 years, how much profit do you think we could make? Ready? Let's get to work. Okay, the first thing we're going to do is we're going to set the parameters for how we're going to look at Facebook. And as we do it on this channel all the time, we want to look at 5 key attributes. Number 1, top line revenue growth. It must be growing. Number 2, earnings growth. We want to see earnings growing. Number 3, strong free cash flow. Number 4, low debt. That's less than 3 times debt to EBITDA. And number 5, a well-priced stock. What is a well-priced stock? A well-priced stock is a stock that if you bought it today with a conservative forecast, you could beat the market in 10 years. That's the idea. That's the game. We want a high probability of outperforming the market, and we focus our money into those core holdings of maybe 20 to 30 stocks that we're going to hold for 10, 20, 30 years. All right, behind me is the recent the quarterly announcement that Facebook issued, or Meta, I'll call it Facebook because I'm used to calling it Facebook. Let's take a look and see what this is, because the market absolutely lost its mind, and let's figure out why. Revenue for the 3 months ending September, $27.7 billion, down 4% from $29 billion the prior year. Operating income, $5.6 billion versus $10 billion, an operating margin of 20% versus 36%. Now this is very interesting. The market is absolutely losing its mind for the drop in revenue and the drop in profitability, which is true. Revenue fell year over year by $3 billion, and operating income fell almost by half, 46%. But the interesting thing here is it's still profitable. It still made $5.6 billion on one of the worst quarters the company's ever reported. Now, we have looked at a lot of companies in this channel, a lot of things like Carvana, DocuSign, Zillow, a lot of companies that couldn't find a profitable dollar if they fell on it. And their stocks have a tremendous value. Now, they've come down a lot, but they have a lot of value still, and they don't even make any money. Here, Facebook is saying, hey, we had the worst quarter we've ever had, and we made $5.6 billion of operating income. And the stock market might be overreacting here. This is still a company that turned in a very healthy number of $27 billion and a 20% operating margin, which most companies would kill for a 20% operating margin. Historically, they've been almost 40%. So I think that's why the market is reacting. Obviously, it's different than what the market expected. But the reality here is a company that's still operating at 20% operating margins, $27 billion revenue in a quarter, and $5.6 billion of operating income. There's a couple other things in the release that I want to read that I think are very interesting. We can come down to the bottom here. Share repurchase program. So it says September 30th, 2022, we had $17.8 billion available and authorized for stock buybacks. That's really, really important. I think they should be taking advantage of that right now. Cash and cash equivalent, they have $42 billion of cash and cash equivalent. That is a lot of jack. $42 billion in their checking account and the investable security lines on the balance sheet is a tremendous war chest that they can use to make acquisitions during this down market. They can use to bolster their own growth strategy. They can weather the storm. I was going to say they can fund the losses, but they're still making money. That's the crazy thing here. Really, really interesting. Facebook's monthly active users, daily active users were almost 2 billion users on average in September, an increase of 2% year over year. They're still growing their users. They're profitable. I don't see why people are freaking out so much. Now, reading through the CFO's comments, I do want to see them cut a little bit more. The people who are being let go, sadly enough, but they are going to receive a very healthy package for people being let go. They're going to receive the restricted stock awards. They're going to receive 6 months of pay. They're going to receive all of their benefits that they have accrued, and it's going to be very expensive for Facebook over time as these people wash out. So you're not going to see a margin jump next quarter as they have to pay out these benefits, as they scale these people out, as they consolidate their real estate holdings. It's going to take them time for that to wash through. So you're at least expecting a year before you start seeing the benefits of these cuts. And I still think there's more room here. If this is the first cut they're doing in the company's history, there's definitely going to be more to come. And I think over time, if management can kind of like steel themselves, they can use this time to reset the company, reset the margins, and then go forward and grow after that. But I wanted to share with you the Q. Let's take a look at how this stacks up historically, and we'll make a forecast for the business and see how much money we can make. Ready? Let's do it. Okay, Facebook, Meta, whatever you want to call it. Let's take a look at how much money they've made on revenue in the last 9 years. Revenue, 2013, $7.8 billion of revenue in 13, and that has grown every single year by $40 billion by 17, 55, 70, 85, 117 billion by 2021. And I read some analysts' forecasts out the next 10 years are still thinking they'll continue to grow and could be around 200 billion by 2031. That's an annual growth rate of 40%. Now we know this is going to come down. Their recent Q in terms of earnings profit is down 30%. Quarter over quarter. So it's definitely going to have to reset. But I think the argument here is perhaps the market has reset harder than earnings are going to reset. And we're going to take a look at that in a bit. Let's take a look at profitability. So profitability, A, they've been profitable every single year. B, profitability is growing. 4 billion, 6, 8, 14, 23, so forth to 54 billion out 9 years, and that is an average growth rate of 39%, roughly equal to in fact, very equal to the revenue growth. So revenue is growing, EBITDA, enterprise level earnings is growing, and it's profitable every year, and it's even profitable in a quote unquote down quarter that they just printed. That's actually very remarkable for a business. All right, let's take a look at enterprise value. And enterprise value is the entire business. You want to make sure you have the debt and the excess cash included. Debt for Facebook is very, very low. They have been very prudent with debt. $14 billion last fiscal year of debt, but last fiscal year they had $31 billion of excess free cash flow. So I net these two and it's zero. I take the market cap. Market cap is average shares outstanding times price, and I get market cap, and I add that with the debt less the cash. I get the enterprise value. That's the entire value of the business. Now this has moved really, really quickly. $130 billion up to just shy of $1 trillion last fiscal year. Now that's obviously come down. I'll take a look at it in a second, but I wanted to get to a couple things. One, the debt ratio is 0. We covered that, so there's no leverage here. They can pay off the debt that they have with the cash, so we can net that to 0, and that's an unlevered business. What does that mean? That means you and I, as equity investors, are at the bottom of the capital stack. What's a capital stack? It's the capital structure of a business. Think of if a company goes bankrupt, it goes in front of the court system, and the court awards the assets of the business to the liabilities of the company, and then finally the shareholders if there's anything left. The interesting thing here is there is no net debt, so any asset in a bankruptcy or trouble filing would go to the equity holders, which would be you and I. So that means that we have bond-like protection with an equity-like upside, right? So if you're a bond investor and you bought a bond in Facebook, you're making your 6%, you want that 6% is fixed because you get a protection. You're ahead of claim of bankruptcy of all the equity holders, and you pay a fixed return for that, which is 6%, hypothetically. Here, there are no debt holders. And so that means that us as equity owners have the collateral position as a debt holder, but we get the upside of a equity holder, which is very, very rare. We like that. That's a nice thing. Second, enterprise value to EBITDA. This is a relative value metric. It just says, hey, take the total value of the business and divide it by the earnings it makes annually and tell me how many years it would take to operate for it to pay back itself. That's like a multiple. It's called a market multiple. And we want to make sure we're not paying too much, because if growth stalls, it's going to take a long time for you to make that money back. Historically, Facebook traded at a very, very high premium because growth was so fast. As growth has moderated, the multiple has also moderated as well. On average, this stock traded 23 times multiple. Actually, recently at 17 at the end of December, end of last year, it seems pretty reasonable at 17 times earnings. Certainly better than 33 times earnings. But this is just market information. We're going to use this when we forecast forward to figure out how much money this company makes. But let's take a look at cash flow right now. Hey, sorry to interrupt. If you like the content, please subscribe. I greatly appreciate it. Also, if you want more stock tips, check my website out, cashflowinvestingpro.com, where I produce one-pagers like this one summarizing 10 years of financial information for American Express. I give you a forecast of what I think it's going to do, and currently, I think it's yield 23% IRR for the next decade. An amazing stock pick. There's lots more. Check out the link below for a free one-pager at cashflowinvestingpro.com. Let's take a look at free cash flow. Now, cash flow from operations is really where you want to begin, and that is the hard jack that the company makes every year from actually running their business. Now, I've adjusted this number, cash flow from operations, adjusted for stock-based comp. And let me show you what I mean. Now, CFO cash flow from operations, the first third of the cash flow statement is right here, and that's growing very nicely, $1.6 billion to $57 billion last fiscal year 2021. However, they gave a tremendous amount of stock to their employees, a lot of stock. And what I like to do is I like to take the value, the cash value of that stock and subtract it from cash flow from operations to get an adjusted number of what you and I would actually experience as an equity owner. And last fiscal year, they gave $9 billion of money away to the employees. And that is roughly 16% of the entire free cash flow they gave the employees as part of their benefits package. That's a tremendous, tremendous expense. I would like to see Facebook bring that down. They are not giving enough cash to the equity owners who are taking the risk of owning this business. So what I've done is I've netted this, because even though they are laying off employees, they're not going to stop giving stock to their employees. So this is going to continue. It's $48.5 billion of free cash flow. Still positive, still growing, still a very robust number, but it's just less than it used to be. The next thing we want to look at is CapEx. CapEx is how much money they put back into the business at the end of the year to reinvest in the business. So last fiscal year, they had $48 billion of jack piled up on the table that the board of the directors said, what do we want to do? Let's reinvest. Let's reinvest $18.5 billion back into the company, paint the buildings, new IT systems, new desk, chairs, computers, new mainframe computers, whatever they need to do to keep the ball going, keep the machine going. This is not acquisition money. This is money that is reinvested in the business to grow and to maintain the infrastructure. All businesses need to reinvest. Think of a pizza shop. You might have to upgrade your pizza oven every couple years to make sure it runs properly and is continuing to give you pizzas. Same thing with Facebook or any business. So that's CapEx. What we want to do is you want to look at the difference between this number and this number. It needs to be positive, and it should be as wide as possible. That means after the $59 billion of jack that they made, they put 18 back into the business, and you get to keep that $30 billion of pure cash, which comes to us as the equity owners. That's what we're buying. Facebook has zero debt, so this is essentially zero. So that means that the free cash flow, the true free cash flow of this business to equity owners is was $30 billion last fiscal year, and has grown from flat to $30 billion at 115% annual growth rate. This is obviously way too low, but say it's $3-4 billion, has grown 10x in 9-8 years. That's amazing, amazing growth for a business on a pure cash basis. That's what you and I are buying when we buy stocks. The question is, how much to pay for this? What's too much to pay for this? What's too little? Is it a fair price or cheap price? That's where yields come in, and that's where market multiples come in. They are multiples of this, or yield is basically this number divided by the market cap expressed as a percentage. Shares outstanding have been growing. Shares outstanding have been growing slightly. I would like to see them buy those down. Free cash flow per share, just take this, divide by this. You're basically making a $10 roughly last fiscal year per share that you purchased. Now, here's where it gets interesting. Share price. Share price last fiscal year is $366 or a $336 or a 3% yield. And you can see this yield has been low single digits. That, historically, that is commensurate with other high growth names. You think high growth names, Salesforce, Facebook, Google, Netflix, Amazon, these guys have single digits. I'm talking 1%, 2%, even sometimes less than 1% free cash flow yield. What we buy cash flow. So we can't buy companies that are yielding that low. We want to see something at 6, 7, 8, plus 10. There are stocks right now in the stock market yielding 13% annual free cash flow plus growth potential. Check out the Cash Flow Club description down below for those hot stocks. But Facebook, let's get back here, 3% historically. Let's figure out how much it's making right now and what do we want to do. All right, I want to pause here for a second, just give you some context for the most recent pricing of Facebook. So the blue line here is the market, is the EBITDA market multiple here, this one. This is what we talked about, where it was 30 times and now it's come down. It's come down a lot. It's come down to be single digits recently, which is amazing. It's single digits because it's looking at trailing numbers, so it's looking at the $30 billion of $40 billion of EBITDA that they made last fiscal year, dividing that by the current market multiple, current enterprise value. So that is saying that they expect earnings to fall, but that is a tremendous decline over a 10-year period of time, and it takes a lot of the risk out of the business. Conversely, the yield has climbed almost to 10% recently in the recent price. Very interesting. Let's forecast this business. If you're liking this review, give it a big thumbs up and subscribe. Greatly appreciate it. Also, I want to remind you that I teach a financial course. I give you this Excel model and I teach you how to do it yourself. Check out the description down below for the link for the cash flow investing course. Okay, let's forecast this business. So how are we going to forecast this business? Where do we go from here? Nobody knows what the future is going to hold. I have no idea. The question is, what forecast do we want to put forward that's conservative enough that we're willing to put our money against it? That's the idea. And then if the stock price, if the return based on that conservative forecast beats the market, then it's worth doing or worth considering at least. So I am significantly haircutting EBITDA. $36 billion, $37 billion next year is a monster cut to the EBITDA. And 2022 is almost already done. So what I've done is I've taken the most recent quarterly numbers and which has fallen 33% year over year, and I applied that to the full year. They're going to beat this number for sure. The question is, what comes next? I think the following year, they're going to continue to be lower than where they are now, right? Last fiscal year, they were at $54 billion. They're not going to get there again. It's going to be a long time before they get there. So what I did is I said, I'm going to haircut this year. They'll probably beat this number. Next year, however, I don't think they're going to go back to 54. I think they're going to sit around $40 billion. They're going to continue to come down from this high point of $54 billion. Whether that falls into 2022 or 2023, I think that's immaterial. We're long-term investors, so I want to figure out how much of it I think they can make over 10 years and what's that long-term earnings target for them. The cuts that they're making are going to take time for the savings to be realized. So I'm basically saying, no, throw $54 billion out. Call it $40 billion is where they need to be out a couple years. And then over time, I do think they will continue to grow to about $60 billion. Again, this is just a forecast. Nobody has any idea what's going on. I would be interested in buying this stock if, based on this forecast, which I think is a conservative number, haircutting their earnings 33% is a monster cut, and then growing it at 5% after that over a long time. If the stock price currently pays a better market return based on this forecast, I'd be interested in buying the stock. Okay, so it's saying $60 billion is all I'm willing to give them credit for out 10 years because I'm not too sure where they're going with the metaverse, and I'm not sure they can grow their existing business all that much more, so I'll say $60 billion. I'll then apply a conservative forecast. A 15 times market multiple is much lower than they have ever been. So if you look in history, our EBITDA market multiple has been in the 30s, a low of 12 here, and up to 17, 19. I'm saying out long term, I'm going to hold them at 15. I'm not going to give them 20 times enterprise value anymore. So I'm lowering EBITDA out long term, and I'm lowering the market multiple. That gives me a $900 billion enterprise value. There's no debt, some cash. I've got outstanding shares of just shy of 2.9 billion. That means a $323 price target out 10 years for Facebook, based on the enterprise value to EBITDA market multiple. Free cash flow is much the same. Now they have no debt, so any change in the EBITDA will most likely flow through to the free cash flow. That gives me a nice haircut on cash flow. So it was $10 per share when EBITDA was super high last year. I'm going to bring that down. Next year's this 2022 number they will most likely beat because they have 3 quarters already in. I'm taking this most recent quarter, which is down a third, 30% year over year, and I'm applying that to the full year. So they will most likely beat this number, but long term, they're going to be in this range. That's the point of this. And they're going to grow over time to about $10, $11 per share. If I apply a 5% yield to this, again, the yield is 5%, whereas they have been historically at this, 1-2%. That's a big change. That means there's a $222 value per share for the stock out 10 years. All right, as we update the pricing for this stock, I want to show you what has happened recently. So the blue chart is the enterprise value of the company of Facebook. The yellow line is the market cap. The purple is net debt, so that's just debt less cash. So it's below zero because they've always had more cash than debt. Fine. Look at this green line. This giant fall here is the collapse that's happened recently. And so what we're trying to do is say, okay, we get earnings is going to fall. We don't know how much earnings is going to fall exactly, but we can put a guess at it, which we have. And then we're going to compare that guess to the decline in the market cap to see if it's fair or not. See if the probability of getting higher returns by buying now on a conservative forecast is possible. So here we go. Let's take a look. We have two forecasts for Facebook. We have a free cash flow method of $222 per share, and we have an EBITDA market multiple method of $323 per share. I'm going to average those for $273 per share. Now, I look out on the market, and I can buy as much stock as I want right now for $113 per share. What does that mean in terms of enterprise value? Well, that means based on this price, enterprise value is $300 billion. That's almost 2/3 off what it once was, right? It was a $1 trillion business. It's now trading at only 30% of that. That's incredible. Next year's EBITDA 2022, which I admit that I have overly cut for simplicity in the model because they've booked 2 of the 3 quarters were $10 billion of EBITDA alone. I've haircut it significantly. So they will beat this number. The point here is to put enough conservatism in it so that I have some cushion. And I'm saying, okay, let's just say out next year, the year after, they're in this $36 to $40 billion EBITDA range. That means I'm buying this business at 8 times forward earnings, 8 times EBITDA, or a free cash flow yield of 6%. That is an amazing value in my opinion. And what I like about it is that this 8 times is already significantly lower than the EBITDA market exit multiple. I gave it 15, and a whole lot lower than I've ever seen it for this company in its history, at least this history. So I think that's a compelling argument here that there's a market multiple expansion opportunity, which is one of the hallmarks that we look for as a qualifying a stock as a trifecta. Remember trifecta? Earnings growth, market multiple expansion, and share buyback. That's the kind of magic formula that we look for when we're looking for a stock. And this is really interesting that you can buy the stock so cheap. Let's put this into an IRR and see how much money we can make. All right, here's the IRR calculation, right? IRR is the math form. It's time-weighted internal rate of return. It assumes all money is reinvested at the same rate. It's a theoretical number. Facebook does not pay a dividend. This is the fractional share of free cash flow that you own. Remember that giant free cash flow of $30 billion number? Let's see. Right here, $30 billion cash flow. This number on a per share basis was 10 last year. It's going to be in the future, my guess, 686 and grow over time. This is your pro rata ownership of the company's free cash flow if you bought the stock. You bought it at 113. You own this free cash flow and you sell it at 273. If I do this on an IRR basis, I get a 17% annualized return. That means if this happens, you will make 17% on your money every single year for 10 years. You will make almost a little over 3 times your money in total return. Now, one caveat. This, I said, is not free cash flow. So what happens? People get confused in the IRR calculation all the time. It's probably the number one question I get. This is not a dividend. And the reason you can still count it is A, they can use it to buy back shares, B, they can make acquisitions with it, or C, they could dividend out in the future, but it's still your pro rata ownership. Even if they don't do all of those, it still sits on the balance sheet, and the stock market always judges how much cash the stock has on its balance sheet when it takes into consideration the price. So anyway, it's going to be reflected in the stock value over time. So you can make 17%, which is a very attractive return. Stock. Let's put this on a perspective basis. So if the stock market moves, you want to look at this video 6 months from now, see where it is. Based on the current forecast, at $113 per share, I can make 17% on my money. If the stock price goes up, it's less attractive. Still interesting, still market beating, right? The S&P 500 would do 10% at any 10-year period of time in its history. So even at 150, it's still beating the market based on this forecast. And if it declines, it's been sub $100 recently, which is an amazing opportunity for a very incredible stock. So let's recap the 5 key factors. Number 1, top line revenue growth. Yes, check the box. Number 2, earnings growth. Yes, check the box, because we are interested in long-term earnings growth. There's a reset that this company is doing right now with the layoffs and with the market itself. That might take a year or 2 to bottom, but we are long-term cash flow buyers. We're not stock flippers. This is not a trading channel. So if you're buying the stock for 10, 15, 20 years from now, we expect earnings to grow, so we're gonna check the box. 3, strong free cash flow. Yes, free cash flow is very strong. Even after reducing the free cash flow for share-based comp, it still easily dwarfs CapEx. They have no debt that passes through to us as the shareholders. That's a strong free cash flow. Number 4, low debt. So debt is 0. Can't get any lower than that. Number 5, well-priced. Yes, I think the stock is well-priced because the forecast on a conservative basis is expected to beat the market. So I would give this a good investment. And I'm wearing the trifecta t-shirt today because I believe it's actually a trifecta opportunity, which is a rarity, especially in the big tech field, where you can buy a stock that has earnings growth long-term, as market multiple expansion possibilities. We're buying it at 8 times, we're exiting at 15 in the future, and a share buyback program, which they're going to execute in the letter that says how much cash they have and they've been approved. So I think that's very, very attractive and a very interesting risk-adjusted prospect in this current very weird stock market that we're in. Now, if you liked what you saw here, I want to encourage you to check out in the description my website, cashflowinvestingpro.com. In there, I teach a course. It's an investing course where I give you this Excel template. I give you 10 years of Apple 10Ks, and we rip through them together. It's 3 hours of content with slides that you can download, the slides, the Excel model. I give you everything. I give you the 10Ks, and I walk through how to get revenue, how to calculate EBITDA, earnings before interest, tax, depreciation, and amortization, how to find that. What are one-time items that you should be adding back, like legal settlements, or like the closing of, like Facebook is laying off people, they have severance costs or they have impairments. That's fine. What you don't add back? Well, you don't add back share-based comp. You don't add back some of the nonsense that some companies want you to add back. You only add back what you truly can. I teach you how to adjust for stock splits. I teach you all that, how to forecast, what market multiples are. If you take the course, do it once, it'll teach you for the rest of your life. That's a promise to you. You're going to get a lot out of the course. I have a lot of people taking it. They've really, really enjoyed it. It's better than some MBA programs for sure, and it's very, very affordable. That's if you want to do the work yourself. If you want to do the work, take the course, build a portfolio of 20 or 30 stocks, have a forecast for each one of them, reforecast every single year so you truly understand the business. You're not going to be right in the forecast. The idea is to be directionally correct and have enough conservatism in the forecast to where if you're wrong, you're not hurt too wrong. You don't miss earnings too bad. You don't pay too much for cash flow. Now that's if you want to do the work yourself. If you want to dig through 10Ks and do all the work, that's fine. If you don't want to do the work and you just want to be fed interesting investment opportunities like Facebook for your consideration, I would highly recommend you check out the Cash Flow Club. The Cash Flow Club is a club where it's a monthly membership where me, several other analysts produce cash flow one-pagers like this one here, where we summarize in one page for you a stock's potential. It gives you 10 years of earnings and revenue information, debt levels, free cash flow. We forecast, just like we do here, EBITDA and free cash flow. We give you a write-up and we summarize the 5 key attributes right on the side. What I like to do is I take stocks that I really, really like. I print this out and I keep it on my desk. And I look at it every quarter. Because stocks might be expensive. Like Facebook, I have liked for a long time, but it's always very expensive. It's cheap now. You print these out, you keep them on your desk, and you cycle through them, reminding yourself of the stocks you would love to own. And when they fall in the range, you can buy them. You don't have to start the research when the market's down. You already have the material. Now, I will say we just hosted a webinar in the Cash Flow Club where we posted a number of stocks that are yielding, expected to return 20, 30% return like we did here. One of those stocks was Yeti, and Yeti was up 32% in a single day 2 weeks after we posted it in the Cash Flow Club. I highly recommend you check it out. We've got a lot of very talented analysts publishing research, their thoughts in there, and this is the only place you're going to find kind of an unbiased review of a stock. We're not an investment bank. We're not trying to solicit investment business. We're just giving an honest opinion of what the stock market might be. So definitely check it out. It also gives you perspective on stocks themselves. If you're looking at dozens of one-pagers, you will get a feel for what the market perspective can give you, and that perspective is worth a tremendous amount. When you choose one that you've looked at 100, you're able to really have a bit more comfort that you're getting a good deal. All right, my name is Cameron Stewart. This is Rational Investing, where we look for hard jack of companies and figure out how much we can pay for it. Facebook's a very interesting company. No idea if metaverse is going to work. Very interesting technology, but I have no idea how to price it. What we're basically doing is just giving a conservative dart on the wall to figure out how much cushion is there in the stock if we bought on the forecast that we put forward today. Thank you very much. Up is going to come a couple other videos that might have other value stocks in them. Check them out. Throw a comment down below. Helps the algorithm. Give me a like and a thumbs up. Really appreciate the time. Thank you very much. Have a good day.